Let me present you a member of a group now that's being formed called tenSigma. Theo is he's been a long follower of decentralized insurance, of many projects here, including EtherRisk. At some point we had a chat, and I recognized that Theo might be the person who would make a great contribution, so I offered help to research, and ultimately one day I'm looking forward that Theo, their team, with the help of you and in partnership with some others in this room, that will be the first risk pool token will be launched someday. And now I would like to welcome Theo to share his vision, how to get it, what it will look like, and welcome.
Thanks, Renat. Insurance risk tokenization on the blockchain, that's going to be the topic for the next 15 minutes. I could have subtitled it, Insurance Meets Capital Markets. To give you an idea where we fit in the EtherRisk ecosystem, we're a group of keeper, about 4 people at the moment, plus the support of the EtherRisk team. And we're working on this part of the overall equation. So tokenizing risks, pooling risks, and tokenizing those as insurance-linked tokens or securities. Before I jump straight in, I have to tell you a little story. About 4 or 5 years ago, I worked in investment banking in London. I was an M&A banker, and my client universe were primarily online gambling industry participants, so lottery companies, sports betting companies. And there was one particular company that offered bets on lottery jackpots. And the interesting thing about that company was that they reinsured their risk through cat bonds. And then it made click in my mind, and I thought, insurance risk is good. There's something to be done with that, right? It's an asset. Don't be afraid, don't be scared, use it. Now why? Why is it an interesting asset, and why is it that people want to own it? On the one hand, insurance risks have a low correlation with other asset classes. In particular, those asset classes that give you exposure to general economic trends. So the correlation between sovereign bonds and cat bonds historically was around 0.11, with equities 0.13, and with high yield 0.2. If you want to make sense of those numbers, it means that sovereign bonds, or a movement in a sovereign bond, explains 11% of a movement in cat bonds. On the other hand, cat bonds are yielding instruments, or insurance-linked securities are yielding instruments. They provide you a risk premium, typically a floating rate, over some sort of risk-free rate, such as LIBOR. Those two elements make even more sense if you think about institutional money management and how institutional investors look at the world. They are building efficient portfolios, and uncorrelated yielding paper is the dream instrument for every portfolio manager. Now, I hope that works. To give you a little bit of an idea how the historic performance has stacked up versus other instruments, this blue line is the Swiss Re Global Cat Bonds Index, and it shows you it's been a pretty straight line, and it performed roughly in line with Barclays, high yield, and S&P total return. But this whole point about not being correlated is the one thing that you can't really see here. But overall, cat bonds have performed, rather well. And the interesting thing you've seen, there's been some correlation between cat bonds and high yield bonds in terms of the overall spreads and how they're stacking up against one another. You can see that cat bonds, so it's this line here versus that line of similarly rated high yield risk, and that line versus this one. Cat bonds are yielding more on a relative basis compared to normal high yield bonds. And then here, those are spreads versus expected losses over the last couple of years. And again, you can see expected losses Historic expected losses were at around 2.5%, 3%, and spreads were moving, but are always north of the 450, 500 basis point mark. Now, the interesting thing, and I'm coming to the problem statement now. The interesting thing about the ILS space is that although those components seem to be convincing, the market is relatively small. The overall outstanding amount is only around $30 million, right? I mean, it's come a very long way. It's grown steadily every year. However, the market, in my opinion, remains behind its true potential. And why is that? It's because the issuance process was designed a long time ago. It was designed for an era with analog technology, right? And if you look at this, so this might be a very convoluted chart. I'm not going to talk about it in detail, but it kind of shows you what the whole setup is. You have the sponsor, it's using an SPV, the investors put money into the SPV, and then it comes down to the collateral. Where's the collateral put? Who's managing it? And on every step, and you can't see that, but every step has a cost layer built in. There's a managing agent, there's paperwork to be done. So the implications are that the issuance costs are very high. You need to have a minimum amount that's relatively high in order for the overall deal cost to be amortized over the notional that's being issued. And overall, you have very high barriers to entry. ILS and cat bonds are an institutional product. So how would an issuance process look like in the digital technology age? This is a somewhat simplified, graph, but it kind of shows you what it is, right? You have the insurance risk that's being underwritten by, various companies, whether they are dApps or could even be off-chain insurance companies. It would go into a risk transformer, which would be an entity that standardizes the risk into tradable security tokens, and then those would be sold to investors, right? And those investors would subscribe to security tokens, so there'd be KYC and AML requirements attached to that. What's the relevance? I see two groups that would contribute the risk. So it's either the insurance dApps that are underwriting on-chain, or it's existing insurance or reinsurance companies, off-chain operator, who could contribute their risk. And the relevance is it provides access to liquidity. So in an ideal world, you could imagine that an insurance dApp underwrites risk, and they don't have a book, but they are running auctions. And our investor base would effectively bid to buy paper, to buy insurance risk. You could refinance existing risks, or follow the typical cat bond model where you just insure the fat tail risks, so the low probability but high impact risks. And you might notice a certain logic to those bullet points. It effectively, it shows that there's less need for a book or for a balance sheet here, and this would be the typical scenario where you have someone who's taking risk on their book. So it's a descending order, less book here, less capital here, more capital here, but you could imagine there's a world where technology companies are effectively underwriting insurance companies, but they're not insurance companies anymore. And so what's next? What are we dealing with here? Roughly speaking, we look at this problem along three different axes. There's a technology layer, there's a financial element, as well as a regulatory and legal component. And what do we mean by that? On the technology side, obviously it's a bunch of smart contracts where we obviously want to use the Ethereum protocol. The financial side, that's more around how is risk underwritten and how is risk sliced and tranched and repackaged into an investment product that investors want to own, right? I mean, this is a big question mark, like why you want to own it, and who would want to own it. And then thirdly, the whole part about legal and regulation. Insurance transfer, it's a heavily regulated area. There's also the added complexity of security tokens. Where can you issue security tokens today? So those are the main pain points that keep us up at night. Individually, we're looking at this and we're going through this and we're saying there's a solution coming up, or it's likely that it will come up. But together, taken together, the dynamic of these problem statements, slightly have a different momentum. Oh, next one. Okay, so closing remarks. Get in touch with us. What we are trying to get out from this conference today is to reach out to each and every one of you, because we hope we have a captive audience in you, whether it is that you are building insurance dApps and you're underwriting risks and you're looking for a refinancing channel or a risk management channel where we could take the fat tail risks of your books, then let us know. We also want to use this to put out this call to action and say, if you're interested in this topic, we're a small team today of around 4 people. If you think this interests you and you can add value, then please get in touch with myself or Alexis, the gentleman in the middle. Maybe raise your hand, Alexis. And just let us know. I think the more the merrier. This is a problem that 2 people won't be able to solve, and this is so gigantic that it takes a couple of people to make this happen. But overall, we are incredibly excited to be here. We are incredibly excited to look at this. We wanted to get involved into this space from the very beginning because we think there's a lot to do. And yeah, join us, and we'd be excited.
Any questions? One question, if any.
I think we have time for questions after.
Okay, great. We'll have a panel coming. Yeah, please, go ahead.
Just one question. When you sell all those products, risk packages, onto retailer, do you also have to take care of the tax implications? What do you have legally?
I mean, taxation is investors, or it's the retail investor's own problem, right? I mean, we would issue security tokens, but whatever tax they're paying on that, that's their own thing.
So it would not be within your responsibility?
No.
Yeah, I think we're missing some people here. We actually started getting into real usage questions. So international tax attorneys are welcome to join next D1Conf. Great. Thank you, Theo. And now we...